Good morning. I'm Tim Nyland, and I just returned from a week-long vacation with no cell coverage to find out that 4 of our 6 mega cap tech ECP macro tilt names, Apple, Microsoft, Adobe, and Google, are at all-time highs today. While Amazon reached an all-time high last week and Facebook reached the same high mark around the 1st of July. That means that all 6 ECP macro tilt names have reached all-time highs in the last 2 weeks. I figured now would be the perfect time to revisit valuations of the mega cap tech names. Since this group combined represents roughly 22% of the S&P 500 by market cap, and probably even more now, I will be updating my spreadsheet model shortly. And as I am speaking now, Fed Chair Powell is also speaking and noting that the economy has made progress, but that there's still a long way to go. This, as he states, the Fed is still a ways off from altering policy. So now we need to revisit valuations for the largest concentration of the S&P 500 mega cap tech names. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. Be sure to request this PowerPoint slide deck for future reference. If you'd like to be able to do the kind of analysis you're going to see in this webinar, then you need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Well, let's go ahead and get started. I want everybody to understand that today's webinar is an extension of 2 prior webinars below, both of which are excellent webinars, and I do recommend that you watch them, if at all possible, in conjunction with this webinar. One of them was recorded first on February 24th, titled Investor Euphoria, Value Rotation, and a Core Equity Opportunity. And the next one I recorded on May 5th, Why Mega Cap Tech Stocks Are Not Overvalued. So we're going to revisit some of these key points right now. From the 5-5 webinar, I had this particular screenshot in there. These are the mega cap tech names, the ECP tilt stocks, showing in April outperforming the S&P 500. So you can see the S&P 500 here, this yellow line, and keep in mind that this is literally for the month of April. So April's performance 2021. You can see that as a group, most of these stocks, many of them, especially if you consider this an aggregate, outperformed the S&P 500 by 2x or even more. When we take a look at this relative to the triple Qs, again, this is a slide right out of the 5-5 webinar. You can see the same thing. So the triple Qs down here, and you can see every single one of our ECP macro tilt names outperforming the triple Qs. So triple Qs down here at 5.35% for the month of April, and you can see everyone else. Okay. So if we were to compositize this into our Zacks Earnings Certain Tilts portfolio, equal weighted, and we were to take a look at the total return performance versus the S&P 500 for the month of April, you'll see that, in fact, we outperformed by more than 2x in aggregate. Okay. And when we look at this relative to the triple Qs, you can see the same thing. So 12% versus 6%. So these stocks have been on fire, and this is something that we talked about in several webinars, the ones that I pointed to earlier in this particular webinar. And what the key takeaway was from that 5-5 webinar is that mega cap tech, when you look at these PEF 12Ms relative to the S&P 500, keep in mind that the end date here is from 4/30 of 2021. So this is from the 5-5 webinar again. Even despite the mega cap tech names outperforming the S&P 500 by a factor of 2 times in April, these valuations are still sitting at literally 9-year lows relative to the S&P 500. So that's with that 2x outperformance, okay? So what we need to do now is look at the triple Qs. And similarly here from the 5-5 webinar, you can see that even after outperforming the triple Qs in April by 2x, we are still sitting now at 12-year lows on the Qs. So this is pointing to the fact that the S&P 500 multiple has expanded so much in excess of where our mega cap tilt names have come from that it's actually pushed that relative valuation down to these record low levels. And we do see these from time to time, but these types of opportunities on a relative basis do not present themselves very often. So I roll in from my vacation and I'm thumbing through my Wall Street Journal issue on Monday morning, and we roll the tape forward here 5 months, right? So back in February, as we first started talking about how undervalued these mega cap tech names were relative to the broader market. And I see strewn across the front page of business and finance section of the Wall Street Journal, tech shares stage a rebound. And you can see here, Apple just absolutely going parabolic, Amazon skyrocketing, Microsoft skyrocketing relative to the S&P 500. And my first thought was, well, I'm not surprised, right? I mean, we've been talking about how undervalued these stocks are on a relative basis now for literally 5 months and even more. And so what we need to do now is take a look at these valuations since all of these names, all 6 of our ECP tilt names, have literally reached all-time record highs here within the past 2 weeks, okay? So now what we're going to do is we're going to look at the performance of our mega cap tilt names since April. And you can see that these stocks are outperforming by a very wide margin. And interestingly enough, you hear about all these names in the press, Apple, obviously, Facebook, Google making new highs, right? Microsoft. But the one company that's in our ECP macro tilt that you don't hear anything about that's absolutely just on fire is Adobe. And you can see that here in green. And obviously, here's your S&P 500 sitting down here at 8.69%. So ECP tilt stocks, the mega cap tech names, just performing spectacularly since April. And we shouldn't be surprised by that, right? We've been saying this all along. Same thing here. When we look at this relative to the triple Qs, the outperformance is just a tremendous margin. If you look at Adobe again, it's more than 2x. But obviously these members here have a much larger weight in the Qs, so it's actually pulling the triple Qs up as well. So at any rate, we're still looking at, in aggregate, an outperformance by the S&P 500 since April. So this is going to encompass April, May, June, and a portion of July all the way through 7/12. Outperformance of greater than 2 times the S&P and greater than roughly 7% by the triple Qs. And you can see that here, 18.6 versus 11.6, so about 7%. Okay. So what we need to do again is talk about valuations, right? How much further can this go and what does it mean? And so if we look at these same charts, you can see this outperformance playing out. And you can see how much of a blip it's had. I mean, it's really not that much. I mean, in order to mean revert, we'd have to go back to a median of 2. We're only at 173. We've literally just come off the lows. The high is 2.5. And you can see we hit these cyclical peaks every 2 years. And we just literally fell through the floor because of this massive value rotation that took place. So now we're starting to rotate back and mean revert. And this is what we expected. This is why I was calling this out basically all year long to date. And so we're still trading at 9-year lows relative to the S&P 500, this despite this massive outperformance by this group of stocks since April of this year. And if we look at this relative to the triple Qs, it's the same exact scenario. And as a matter of fact, the blip here on the radar in terms of a PEF12M is even smaller than the S&P 500. And you can see that we're still trading at lows that we haven't experienced on a relative basis since the recovery from the great financial crisis. And you can see these cyclical peaks that we hit every 2 years. And you can see we broke through the floor here. So we've got a long way to go for recovery. And this is good news for our macro tilt names, obviously. So if anyone ever asks you if it feels like 1999, and I hear this get asked by CNBC contributors on a daily basis, and I just laugh. They say, well, doesn't this feel like 1999? All you got to do is just show them this chart. When you incorporate growth into the scenario, and I have this .com era circled in red for a reason, we're going to talk about that. There's a lot of noise in here. I'm going to show you what it is here in just a minute. So I like to kind of, think about normalized trends in terms of PEG ratios being more between this 1.8 and 2.2 back then versus what went on over here. We all know that the .com era ushered in a lot of negative earnings a lot of revenue growth, and a lot of EPS growth rate estimate forecasts that were just absolutely, high 20s and even greater unsustainable growth. And that's the numerator of the PEG ratio, this EPS GRE. I like to take one standard deviation off of the growth rate estimate forecast just as a measure of conservatism. It gets rid of those outlier forecasts. And so this is a much, much more conservative measure of PEG. And you can still see that we've got some noise in here. So albeit I still look at it, I want to see it, you should be aware of it. Try to visually eliminate it from your long-term historical trend analysis in terms of comparing for measures of central tendency. You want to eliminate that. So if you look at this chart, what it's telling you is that on a relative basis, relative to the S&P 500, in terms of adjusting a PEF-12M ratio for its forecast growth for the next 3 to 5 years, which is what the EPS growth rate estimate is coming in from our estimate contributors, that this group of stocks, this ECP macro mega cap tech tilt, is literally trading at all-time lows. We've never seen it this cheap in the past 25 years. We're just off that low point. And this is remarkable, right? Because the median here is 1.14. We're literally sitting at 0.78, and we reached the low of 0.71 just a couple weeks ago. And so this is obviously despite this massive rally that this group has just had, year to date, specifically since April. We got a long way to go to mean revert back to this 1.14 median. So if somebody asks you if it feels like 1999, you can laugh at them and show them this chart and say absolutely not. These stocks are cheap relative to growth, and here's why. A little bit different scenario when you look at the triple Qs, and you can see this big red X I have here. I'm going to show you the problem here in just a minute. This does have an influence on what we saw for the S&P 500 in the previous slide. That's why I circled it. This you have to eliminate. The only reason I'm showing it to everyone is I want everyone to be aware of how aggressive the growth forecast was for PEG. And unfortunately, it looks like I've got the PEF-12M up here. I apologize. I meant to have this be the PEG ratio. But at any rate, we had a lot of negative earnings in here and a lot of things that were skewing our valuation. So we want to take a look at just the PEF-12M in here. Unfortunately, I meant to make this PEG. I'm not sure how this PEF-12M chart slipped in here. So at any rate, we're still looking at obviously 12-year lows. And again, these stocks are very, very inexpensive. So when you do look at the QQQ and the S&P 500 PEF-12M PEG, that noise between 01 and 03, it's really attributable to this unrealistic EPS growth rate estimate forecast. And for anyone that was around managing money during this time, you'll know exactly what I'm referring to. These growth forecasts, this is on average, 22%. This stuff is just unsustainable. And you can see how that growth rate actually, moderated down. By the time 03 came down, it was all the way down to 15%. We popped back up, and then you can see that we kind of went into this new normal range of 12 to 14%, which is obviously much more realistic for the tech-heavy NASDAQ. So be aware that the consensus EPS growth rate estimate forecast, these were extremely aggressive around the dot-com bubble era. And remember that the EPS GRE forecast is the numerator of the PEG ratio. And so take these figures out here between the dot-com bubble and 02 with a grain of salt. So why are these valuations still so low? The reason why they're still so low, even though we've had this massive move up in terms of price appreciation, is because the numerator of our PE ratio continues to grow at an astronomical rate. I have two periods of time outlined here on this consensus F1 revision chart. 9/30 of 2020 was a pivotal month, specifically month end, for the ECP mega cap macro tilt group, because this is where they pretty much all reached their highs and then tapered off when the value rotation kicked into high gear. What I want everyone to see is the estimate revisions for this December 2021 year have increased almost 50% since 9/30 of 2020. So this is what I've been talking about for the last 5 months, is that while these companies stay more or less flat in terms of price appreciation, they haven't moved much. Prior to the run up we had in April, they hadn't moved much. Now you can see that their EPS estimates have been revised up almost 50%, right? 22 to 30. This is huge since 9/30. And specifically, since we've had the major run up in price, we've still gone up 20% from 331. Remember, the rally started here in April. We've gone from 25.26 all the way to 30.60. Again, in aggregate, consensus F1 estimate revision for earnings. These are huge, huge revisions. So that's why these valuations remain low, is that underlying earnings number just continues to grow at just a spectacular rate. The other thing I want you guys to think of here is the numerator of the PEG ratio itself. And we need to think about that because it's astronomical, right? We all know from watching my prior webinars that the average annual growth rate of earnings for the S&P 500 over the last 25 years is 7%. In the next slide, I'm going to show you that. But what I want you to see here is that we are forecast to grow -1 standard deviation at 15.21%. Okay. The consensus estimate for the next 3 to 5 year earnings growth is 18.4%. We take 1 standard deviation off of that, we end up with 15.21. That's what you're seeing here. That's still in excess of 2 times the growth of the S&P 500. So that's why these valuations are still low. This group of 6 names just continues to perform. They continue to deliver on these earnings, and these growth forecasts are literally in excess of the S&P 500 annual average over the last 25 years by a factor of 2 times. So this is big. And remember, this is what the S&P 500 looks like annualized earnings growth over the last 25 years. So I just literally put the valuation model up on a 25-year price and earnings chart and snapped a least squares fit to the growth line by clicking this LS button. And you can see that that's a 7% least squares annual growth rate. Okay, much, much higher forecast growth for our earnings certain portfolio mega cap tech names. So in summary, mega cap tech ECP tilt stocks are still cheap on a relative basis. This despite the recent run up in price relative to the S&P 500 and the Qs, right? So PEF 12M relative to the S&P 500, 9-year lows, PEF 12M relative to the Qs, sitting at 12-year lows. When we take a look at the PEG ratio, again, on number 3, I'm going to apologize in advance because I didn't realize that that I actually had a PEF 12M chart in there instead of the PEG -1. But at any rate, point number 4 relative to the S&P 500, we saw that was literally sitting at all-time record lows for the prior 25 years. This is huge, huge. FY1 consensus EPS estimates are up almost 20%. We saw that from 331 and 50% since 9/30 of 2020. And again, I just showed that 3 to 5 year annual EPS growth rate forecast -1 standard deviation is 15% for our ECP mega cap tech names. That's again over 2 times the 25-year average EPS growth of the S&P 500 that's clocking in at only 7%. So that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you all for watching, and I'll talk to you next week.